Welcome to this CNBC Africa special, Captains of Industry at that. And today our captain is the CEO of Banque Populaire Du Rwanda, Mr. Maurice Toroitich. Now, Mr. Maurice has an area of experience in the banking sector, having previously led KCB Bank Group in Rwanda as the managing director. Today we'll be speaking banking trades, but there's also that hot topic regarding push and pull payments. Who is responsible for the exorbitant fees that consumers are levied? Now, if you want to be part of this conversation, tweet us at CNBC Africa, or you could tag me directly at The Real Quizzer. Maurice, thank you. Always a pleasure having you on.
It's a great pleasure. Thank you.
Maurice, how do we bring down those costs of the digital transactions?
So I don't think there's a silver bullet answer to that question, but let me try and explore a couple of thoughts that I have. So first of all, when you mentioned that the cost of banking services or digital banking services is still high, I think the point to recognize there is that as long as the consumer is still saying so, then we take it to be so, all right? Because one thing or one debate that one can get into is to begin saying, compared to what what does the consumer actually expect? I mean, if you were to ask the consumer out there, they would probably say, well, let's do it for free. Not necessarily so. And the point here is that I think it's a journey of discovery. I think so. Just like anything technology, I mean, speaking about digital banking services, is that as technology improves, as banks begin to discover, how these services are offered, the synergies between the various partnerships that they forge. My expectation is that the ground will begin to level, and things will begin to come down. I mean, if you think about the cost of technology overall today, I mean, we have a lot more usage of technology today, but costs have come down or remain stable. So I think one is obviously banks understanding how technology can help to improve, especially certain areas of their operations which attract costs, because when those costs come down, then it is possible to pass the benefits of those cost reductions towards reducing the per unit cost of transacting. So for me, I think it's about leveraging technology, newer as it becomes, to then cut operating costs, the cost of doing banking, the cost of intermediating between fund holders and fund users, to eventually bring down the overall cost for not just the banks, but all the actors in the ecosystem, because the financial services sector is an ecosystem. So when everybody begins to see those costs come down, generally speaking, what will happen is that the per unit cost adjusts, in the form of price adjustments as well. I know it's a roundabout, answer, but I think it's really about, banks and other actors in the financial services sector, adjusting, and it's a journey of discovery. We didn't have these channels before. Now we have them. They've costed certain amounts of money to install. They continue to cost a certain amount of money to maintain. But again, the uptake of these services by consumers is picking up. So there will be an equilibrium at some point where, the per unit costs will begin to suggest that prices should come down, or that the value of what is being given to customers increases significantly at the same cost. Because it's also good to look at it that way. What is it that the customer is getting for the price that they pay? Because customers might continue paying the same price today, but for a lot more services in future than maybe what they're getting
Maurice,
today. Again, that's the other way of looking at it.
That's a very detailed answer. Why don't you just break it down for us? And here, let's go into a bit more specifics. These fees, which have been termed "quote unquote" exorbitant by consumers over the past week, what's their cause?
So first of all, let's break down to what these costs are. Okay, so. And I think last week, the biggest conversation was about the cost that consumers spend, in moving money from bank accounts to the mobile money wallets, right? So meaning I have a bank account and I want my money to go into, say, an MTN wallet or an Airtel wallet in order for me to do a transaction from those platforms. So there's a transaction charge that banks levy for moving that money from the bank account to the wallet. Now, I think the conversation was that it costed more for a customer to do that than that customer walking into an ATM, withdrawing cash, and paying for whatever they wanted to pay for in using cash. So a very, very valid line of thinking. That if that gap is that significant, then the consumer will see it. The consumer will play the trade-off between whether I should spend 1,000 to move money from my bank account to MTN money wallet so that I can buy an item in a supermarket, or well, I could wait until tomorrow, go to the ATM, or I can actually drive to the next ATM, draw money, and go back and to the shop and pay for whatever I wanted. So again, it's about what the customer values. All right. So for as long as what the customer sees as the value of that instantaneous mobile money transaction versus the cost that it might cost them to wait or to travel to get cash from the counter, they will make that economic decision.
Yeah, that's where I see a disparity between one, what
Yes.
The Ministry of Finance and Central Bank is saying in terms of pushing for digital transactions, and what kind of conversations they're having with you and the Bankers Association in terms of ensuring that this is achieved. It feels like 5 steps forward and 7 steps back.
Arnold, I think we've made a lot of progress. I mean, if I look at, for example, the kind of fees that we currently charge as BPR specifically, in 2021 compared to what those fees were in 2019, it's a milestone. And the reason for that is because we've increased our transaction volumes from just about 10,000 digital transactions 2 years ago to now coming to almost 60% of our total transaction volumes. And the fees have more than halved, okay? Where they are, of course, I can understand that some customers will still feel that it is high, but the trend is downwards because the volumes have gone up. However, the main conversation that we are having as an industry is that, we have to look at it from the point of view of taking the loss initially to build the volumes, meaning invest and not charge for it, because that's I think what would be the most favorable situation to find yourselves in. And therefore, once the platforms are in place, once the customers get used to the platforms, then your per transaction cost comes down, and therefore the fee that you levy will be affordable, will be acceptable to the consumer. I guess the balance to strike is this, that building these systems and platforms obviously costs money upfront to the banks. And so the conversation in the boardrooms of banks is, what level of investment is tolerable that might not generate a return now, and for how long before you actually begin to see those volumes come through the door, in order for you to begin generating small margins, but over a large number of transactions. So I think that's the trade-off. And like I said, there's quite a bit of a learning curve, that banks have to pick up here, because it's one thing to make an assumption that you put in $3-4 million of an investment to build a robust digital payments platform, and for your shareholders to say, all right, fine, we are happy to wait for 3-4 years, for that to feel in terms of revenue. It is the conversation that we are having. It is a long-term view of what needs to happen now in order for the banking services to become affordable, and it is an investment. I mean, those conversations are active at the association level. They are also active at management level in banks, and they're also active at board levels. I mean, at the same time, these conversations are actually also going to shareholders because think of it, when you invest money today and you don't generate a return. I mean, we started off earlier on with a light conversation about dividends. I in particular in BPR today, are struggling to explain to shareholders why we haven't paid dividends, because we are telling shareholders we need the profits that we make to invest in the business, to build these technologies that we are building, to support the infrastructure that we are building, so that the expected returns for these shareholders in future will be better.
I want us to go back where we were, and I want us to bring in a third party here. You've talked about BPR's transactional fees, and I have two questions there. Why? Yes. And I believe you're not allowed to speak about your competitors, but why is there a big disparity in the banking fees? Could it be sensible if central bank came and stamped its foot down and said, let's have a uniform fee, for all transactions? Or will that, in a way, have, entangle some form of competition and innovation that is needed in the sector? My second question there also would be around bringing in the third party. Now, if you're bringing in the telcos here, who are your clients as well? And, they're coming in with innovative products. Some of them are becoming your direct competitors. They're talking about a third-party account. They're talking about, those fees being brought about by, the current legislation. Couldn't we find a gray ground there to ensure that if someone is pulling from their MTN, Airtel, Orange, whatever, mobile money, Safaricom wallet, to their bank account or vice versa, that it could be much, much cheaper?
So first of all, Arnold, I personally am a believer of free markets. Of course, I am also very cognizant of the fact that it is important for private sector actors in a free market to facilitate the operation of the market. So competition does the job, all right? So you speak about the disparity between fees charged by one bank to the other. Typically, when the market, or let me say, when the consumer is very well informed about what is possible in the market, they will usually, be able to move to the provider that gives the best service. Now, and I'm being very careful here because it's not just about the best price; it is about the best service for the price paid. All right. So it's possible that one provider may charge slightly higher. But again, offer a much more superior service or value addition, to the customer engagement. And so for me, I think that is what needs to happen. A lot more of competition in the market, and it is there already. All right. The banks, the telcos are playing in the payment space today, and each one of these entities is competing for the business from the customer, and the customer has pretty much the freedom and the choice to either use a BPR service or a Bank of Kigali service or a telco service for a certain payment. I think eventually what will happen is that when we begin to see the ecosystem from a partnership perspective, we'll probably see a much faster rate of development of that market, because then you begin to see the disparities and the cost inefficiencies that arise when each one of these actors invest and act on its own. So the way we determine pricing in BPR, for example, will not be the same factors that might determine the way price is set in another bank, because they have their own set of how can I say, cost bases. They have their own set of profit targets. They have their own set of parameters that they look at, from a strategy point of view. But eventually, it is the consumer that tells you what is right. And so, they like I said, it's a journey of discovery. I believe that between now and the end of this year and next year, a lot will have changed in the market, because the consumer basically determines where the market goes. Of course, the partnerships, and I think here, one thing that I see that is likely to make a very big difference here is the infrastructure in the payment environment. So if we had more, for example, ability to be able to seamlessly integrate payments from one actor to another. I think we have a market that is hugely disintegrated today. Each actor doing their own thing. But if interoperability, and I think there is a very big initiative that the government is driving currently to make that possible, then you have an entity that carries the cost of integrating payments between various actors. And so then what would be left is the value of service you give to your customer, because then based on that, the customer will then make the choice of who to go to, because the underlying cost is uniform and standard. So it's about now, the value of service you give and the price that you charge for that service, as opposed to factoring in the cost of certain infrastructure, which in one bank, it might be a Rolls-Royce, in another bank, it might be a Toyota. And so the cost is then not level, if you call it that.
Toyota, Rolls-Royce, I don't know which one Banque Populaire Du Rwanda tends to offer to its clientele. But Maurice, you talked about consumer being...
We are a Toyota bank, very reliable, but very affordable.
Maurice, you also talked about a customer consumer being king. An old saying there, but I want to go to your actual bosses, or the people you report to, who are your board. And with the boards, they've not been very happy over the past 12 months. Banks are making profits, but they can't cash out their dividends. And earlier you said, you're using that to reinvest in certain banking. But I want to speak for the shareholder this time and say, if a law is passed, because the central bank is the one that asks dividends not to be paid out, some of your competitors are going back to the central bank as we speak and asking the central bank, look at our books, look at our profitability. We are able to stay liquid. We're able to meet our reserve ratios and are still able to perform at the level at which we are required to perform. So why not allow us to pay these dividend payouts? Because eventually you will have to pay them out at one point or the other. What's your view on that?
So first of all, Arnold, I think it is important to think about the reason, first of all, why central bank came out with that directive to banks. We are living and operating in a very uncertain moment in our banking lives. The impact of COVID on banking customers, is real, and it is here with us. So central bank obviously plays the important role of ensuring stability, of ensuring longevity of banks. And I usually like to think that the objectives of central bank are not in disagreement with the objectives of shareholders of banks, because I have one rule that I was taught in my life, that whenever there is doubt between short-term outcome and long-term outcome, go for what will give you the long-term outcome. So I think this is a choice that we are making today, that the current period is uncertain. We have not yet factored in fully the impact of COVID-19 in our loan loss provisions. We don't know what that is going to be in the next few months. And purely for that level of uncertainty, I think it's very prudent that capital is then preserved to ensure that, as and when the impact of COVID-19 begins to unfold, or in fact, it might be that we eventually come out happy and clean. But then what will have happened is that, banks then in future, when all that uncertainty has been taken away from our current set of worry items, then we can go back and consider payment of dividends depending on each bank's capital and liquidity positions at that time. But I think it is a prudent thing to do. Yes, shareholders will not be happy, but then again, shareholders invest in businesses for the long term, which means it's not just the profits of today that we should take away, but it's actually about making sure that the profits of next year and the years to come, can be assured. And that's to the kind of actions that central bank took. And that's my take on that.
I feel like I'm sitting at a round table at the BPR office, and you are selling to me this as a shareholder. But Maurice, I want to come to you on a rather personal note. The the past 12 months have been very challenging for you as a leader, and this is from the outside looking in. And correct me if I'm wrong here. You're going through a merger. The pandemic has happened, so it's not very smooth sailings. But there are lessons for a leader in for a finance institute. With your expertise and experience, what have you drawn from this, and how much of a test has this put on you as a CEO?
Look, a test is certainly an understatement because obviously, like you said, I think for every business, COVID has been such a disruptor. It continues to disrupt all of us every day. When we think that things are under control, they are not. Look, I think the biggest lesson, one is, obviously to remain very agile and very prepared for any new outcomes and being engaged with your stakeholders all the time. I think that's really been the key word here, because then, everybody is thinking the same, everybody is seeing the risks the same way, everybody's anticipating the positive or negative outcomes the same way. So I think that level of engagement with all stakeholders, and stakeholders here meaning internally, with customers, with staff, with the board, with shareholders, with regulators, with other partners in the market. I think that's been the key thing, to just ensure that everybody is thinking and acting the same, and providing the support that is necessary to be had in these moments. And obviously, remaining very agile and very prepared to change course quickly, because there's no time to wait for anything to just cost through the way it would normally have in a normal operating environment. So I think for me, that's been the biggest lesson. And then the second thing is that everything is possible. I mean, when you think about how we pivoted very quickly from office-based brick and mortar type of a business to operating in a virtual digital environment. I think the lesson here is that when you see the writing on the wall about anything, begin preparing for it. So we benefited a lot as BPR in the sense that our technology platforms were already on the drive path. So when COVID happened and we needed to move very quickly to using technology as a means to serve our customers, to communicate internally, we were 70% down the road in that journey. And it was really just making that last leap, which would have been very different if we were beginning the journey at that point. And so maybe we were lucky this time, but then again, the way I see it is that, in the horizon, there's always something that tells you that there's likely to be some rain in the course of the day or in a few days to come. And therefore, be getting ready for when that happens. And I think that's the way to look at it, which really speaks to risk management and taking a view about, where the future of banking is going to go.
Well, at the end of a heavy downpour, there seems to be a rainbow. I'm talking rainbows. I want us to, look at 2008, 2009 financial crisis. Pivoting of the financial institutions after that didn't come as fast. And many have hailed the movement. You've talked about how you were about 72 to 75% down the pivoting road when this pandemic hit. So it made it easier for you to get away from the brick and mortar. What are the lessons that were drawn from the 2008, 2009 global financial crisis that have been taken into this COVID pandemic and recovery? Because, most economies still have faced recessions just like then, but it seems like there's, going to be light at the end of this tunnel quicker than before.
I think the one thing that comes to my mind, Arnold, about how we managed the crisis arising out of COVID, probably as a lesson coming from the financial crisis of 2008 and 2009, is that there was no dithering, okay? So the central banks, the banks, and everybody who was involved in managing risk in the financial services sector stepped in pretty quickly. So the Economic Recovery Fund, the Liquidity Refinancing Program, adjustment of liquidity ratios, the restructuring of loans in the banking sector, all that I think was done just at the right time. So we didn't wait for things to go wrong for us to begin taking action. I think in 2008, 2009, first of all, it took a while for anyone to really understand what was going on and even to decide what really should be the right course of action. And obviously, as a result of that, there were failures, there was a lot of pain, long before central banks and governments decided to step in. I think this time around, the lessons from that period were already in the rule books. They were already in the risk management framework. And so activating them was a lot quicker and faster than it might have been earlier on in 2008, 2009. So I think for me that was a great benefit that helped obviously to calm the nerves in the financial system. And we've seen things stabilize as even the impact of COVID deepened in certain sectors of the economy. So yeah, I think that comes to my mind as the greatest learning of that period.
Maurice, banking trends, you're a veteran of this industry. They seem to shift, and at times they tend to shift in a very volatile manner. One of the things we're having right now is a conversation around cryptos and cryptocurrencies. Initially, there was pushback against it. They seem to be here to stay, a hybrid of them, of that cloud service. And AI usage, also incorporation of fintechs as well. These look like they are going to largely push the next banking trends for the next 5 to 8 years, unless someone comes up with something exponential. What do you think the future of banking is for the next decade?
Very interesting, look at things myself. I mean, I usually like to think about things happening in the horizon and make meaning of them. So I've been in banking long enough to know the experience when mobile money began to take root in one of the markets in East Africa, and the reaction then by banks was, yeah, this is not doable. It is risky. We should gang up. Lobby the central bank to stop it. All right, because first of all, it was unusual. It's not something that we were used to. All right. And so when it comes to things like cryptocurrency today, I mean, it doesn't surprise me that the reaction is the same. I mean, we are not used to these. I mean, these are things that we haven't dealt with before. I mean, they are going against the grain. What does it do to central banking? What does it do to money as we know today? I mean, and for me, I think the lesson to draw is, see, the seed is planted, all right? And the idea is already in the minds of very many people. So cryptocurrency will evolve.
Maurice, it's always a pleasure speaking to you. Thank you for making the time.
Thank you very much, Arnold. It's always a pleasure to have this conversation with you.
Thank you, Maurice. Maurice Toroitich, CEO of Banque Populaire Du Rwanda, always with lots of wisdom. Now, that was our Captain of Industry special. Now, if you have any ideas or would like to be part of this conversation, tweet us at CNBC Africa, or you could tag me directly at The Real Quizzer. Have a great rest of your day.